Hey guys, welcome back to another episode with Shane Critelli. Today I'll be discussing my own personal real estate investing strategy that I use to buy the current house that I am sitting in. So don't go anywhere, you won't want to miss this. There's a lot of strategies out there people are using, different kinds of real estate people are buying. Now, this is my own personal strategy. It's not to say it's one size fits all or it's for everybody. It's just personally what I think is the easiest and the best strategy that I use. And I don't know how many people are using this strategy because I don't hear it a lot. So I kind of wanted to make a video and let you guys know about it. So without further ado, let's get into it. So a little backstory about me is about a year ago, a little over a year ago, I was working my 9-to-5 job. I'd been at the company for about 7.5 years. And I was just really starting to get burned out. I've been just doing the same thing for so long. I was in sales. Been in sales for 10 plus years. Been at this current job for almost 8 years, and I was just getting burnt out. And I was like, there has to be something else, And I started to look for another job. There really wasn't anything out there that I really wanted to do. It was just another job that made the same amount of money. And that was another issue, was trying to find another job that made the same amount of money, since the house I was previously in was very expensive. I should have never probably bought it. It was out of my price range. But long story short, I ended up selling that house, making a good profit on it. And what led me to do that was finding real estate podcasts like Bigger Pockets and Rich Dad Poor Dad, and just really listening to these podcasts every day to and from work, at my lunch break, and really liking it. I don't know, there's something about it. My parents always would fix up houses. They never really sold them. They just buy them and fix them up. After reading up and listening to these people that are making money flipping houses and renting them out, I was like, man, this might be something I'm good at. So originally my plan was to basically house hack a duplex. That was what I wanted to do. I wanted to get in the duplexes. I wanted to buy a duplex, live on one side, fix it up, and then rent out the other side. Problem was, duplexes were, with all real estate, there's such a short supply. There wasn't that many deals out there, especially duplexes. Even single family was tough. When I was selling the house, I was going to just rent somewhere until we found a duplex. Studio apartments, 700 square foot, 600 square foot studio apartments were going for like $850, $900 a month. We got 2 dogs. So you got to put all the dog fees in there and everything. And I was like, geez, we could buy just a single family house, a mortgage would be like $500, and we could eventually rent it out instead of paying almost, like $900 a month in rent. So at the same time, we're in contract with my house. I stumbled across the house that we are currently living in. Obviously, we bought it. They were asking $85,000. It was a fixer-upper. We countered, ended up getting it for $80,000. 4-bedroom, 2-bath, 1,900 square foot. It was actually built in 1900. Great home, great bones, newer windows, newer steel roofs, like 10 years old. A lot of it was just cosmetic damage. The owners had dogs, so all the floors needed redone, resanded down. So we were like, all right, let's buy this place. $80,000. I talked to my lender. He's like, primary residence, and you only got to put 5% down. I was like, all right. So it's like $4,000 plus closing was another $3,000. Talking $7,000. I was like, man, let's do it. So we did that. We bought pretty much $20,000 in it in improvements. I had the floors done professionally, and then I had the downstairs painted by painters. But everything else we pretty much did. I did have the electric panel upgraded service to a 200 amp service. That was about $3,000. But so, we didn't do everything ourselves, but we've done like outlets, painted the upstairs ourselves, redid the bathrooms, new light fixtures, painted kitchen cabinets, that type of deal. I put some new plumbing in, just cleaning up stuff that they'd left, like the cellars. But anyway, my lender said, if you live at that house for 2 years, you can buy another property. You can rent that property out and then go buy another single family home and only have to put 5% down and do it all over again. Fix it up, live there 2 years, and just rinse and repeat. And I'm like, man, that's not a bad idea. Because A, well, my wife's pregnant, and B, we can live here and put some sweat equity in, fix up the house ourselves a little bit so we don't have to spend a bunch of money, get a bunch of equity put in this house, and then, 2 years isn't that long of a time. And then in 2 years, we can get somebody to rent it, have a lease agreement signed. I give that to my lender. The lender says, great. And then on the next house we're in contract with, we only can put 5% down, rinse and repeat. And then basically, if we want to, we can go refinance, pull all that money we just put in the house. Like an example, this house, bought it for $80,000. Got about $20,000 in improvements. It's $100,000 in total debt. This thing should appraise for right around 160. Houses in this area, in the square footage and bedrooms and baths are going for about 160, give or take. So, that's $60,000 in profit. Plus, we only owe about $76,000 on the mortgage. So, you're talking, if it appraises for 160, we'll have $85,000 in equity probably, something like that. Which is great. We don't ever plan on selling it or anything, but we could pull some of that money back out. Basically, when you do a cash out refinance, they'll give you 80% of the loan, what the actual house is worth. So basically, we put 20 grand in it, bought it for 80,000. We got $100,000 invested, say, in total debt. So basically what that means is if it appraises for 160, we can take 80% of 160, which is I want to say like 120. So we could take a new loan out for 120,000. Then the difference between what we owe on it and that new loan, which say we owe like 76 right now, probably 75, by next year. So let's take 75, it's an easier number. So 120, 75. So we could pull out almost 25,000, 45,000. We could take $45,000 out if we wanted to, probably. And we've only got $20,000 invested, with closing. Well, with closing, maybe closer to 25,000, but with down payment and home improvements, only got about 20,000 invested. So we could pull out double of what we put in this thing, because it actually appraised for like 90,000 before we even put any money into it. We got a really good deal on this place. So, but you don't necessarily have to do that. We got plenty of reserves. We're probably not going to do cash out refinance anytime soon. We may do a refinance if the rates keep going down. We got a pretty good rate on this place, 3.6, really good. I know they're down to like 3.1, but they say like a full percentage point before you refinance. So I don't know, but we're definitely gonna get it appraised next year. You got to wait a year. Wells Fargo's 12 months before you can get it appraised to drop off PMI, which is your mortgage insurance. So that's the reason we want to get it appraised. Not sure if we'll refinance. Depends on the rates. Cash out. We really don't need the money. We got a lot of money we made off the old property, so we have enough to put another 25,000 in another property and still have enough reserves. So basically that is our strategy. So it's kind of like a house hack plus BRRRR strategy. If you're familiar with Bigger Pockets, you know what I mean. You know what I'm talking about. So basically, you buy the property as your primary residence. Only have to put 5% down instead of 20%. Fix it up, save some money, put some sweat equity into it. After 2 years, rent it out, get it ready for rent it out, and then rinse and repeat. I'm telling you, I feel like this is a really low risk, easy, don't need a whole lot of money to do, especially if you want to fix up the entire house yourself. We could have saved a lot more money. I mean, the floors were $6,000, the electric service was $3,000, painting was like $2,500, and the rest of the stuff we pretty much did ourselves. But there was some stuff we've had to, put new gutters on. That's like $500, $600. We got 3 chimneys here. I just recently had to have them reflashed because the person that did the roof didn't do a great job. So that was like $1,000. So I usually say 15% above what you think you're gonna need for improvements. Give you a little buffer, because we ran some termite damage on the back addition. They kind of added on and closed the back porch, and it was all rotted with termites. And we had an inspection, but our home inspector, I'll never use them again. He didn't do a great job. He missed it. So basically that was $2,000 out of pocket. So but all in all, we're about $20,000 in improvements. So great deal. I think here in next year, once all these delinquent mortgages come on the market, these pre-foreclosures, it's going to be a great time to buy. Yeah, it's going to lower home values, like our home value a little bit, but since we don't plan on selling, it doesn't really hurt us. Rents really aren't going to go down, you know. So yeah, I don't know. I feel like this is a pretty easy strategy, and I think it's one of low risk too, because you got a ton of equity to kind of hedge you from the economy or the real estate market crashing. Even if it crashes, you're probably going to make a profit if you decide you want to sell the house. And if you want to rent it out, I don't see a shortage of renters anytime soon. I don't see rents going down anytime soon, so that's not going to hurt you. And then if you want to pull that money back out like a Burr strategy, you still have that refinance option. And then if you don't, I mean, the only bad thing is we're not getting any rental income right now because we're waiting 2 years before we rent it out. That's one of the cons. That's one of the cons. But you don't have to wait 2 years. If you get the money, you know, we don't plan on just every 2 years doing this, maybe after the first couple, but then after we get some money coming in with rent and jobs and whatever business, we might not need to wait 2 years. Maybe we got the money to put 20% down, not have to wait, you know, instead of waiting 2 years, maybe wait 6 months. So the option's there still. You can still do the conventional 20% down investment properties, but this is a way to at least get started. So I don't know, guys. Do with what you will. If you like this content, go ahead and hit that like and subscribe button for me. Appreciate you guys tuning in every Sunday. That's when I release these videos once a week. Maybe I might move to 2 times a week, but right now we're probably gonna stay at just once a week, uploading on Sundays. So thanks, guys. I hope you guys are staying safe, and we'll see you next time.